Hello and welcome to Sleepy Stories. I hope you're doing well today. Wherever you're listening from and whatever time it is for you right now, I'm glad you're here. It's always fascinating to think about how far a quiet story like this can travel across cities, countries, and slip gently into so many different nights. Before we begin, I'd like you to imagine something. Imagine living in a city where money moves more quietly than armies, where power is written not in laws or crowns, but in ledgers, promises, and carefully folded letters. In 15th century Florence, one family learned how to make this system work better than anyone else. This is a careful reconstruction of how the Medici Bank functioned, what gave it such extraordinary reach, and why, even at the height of its power, it faced limits that no amount of wealth could fully overcome. So sit back and settle in, and let's begin our journey into Renaissance Florence. To understand the Medici Bank, it helps to start with the problem it solved and the constraints that shaped every choice it made. In late medieval and early Renaissance Europe, long-distance commerce was expanding, but it expanded across a landscape of fragmented jurisdictions, multiple coinages, seasonal trade cycles, and political authority that often mattered more than formal law. Merchants needed ways to move value without moving bulky metal, to settle obligations across borders without exposing themselves to robbery or seizure, and to convert between currencies that were not interchangeable at fixed rates. Rulers, cities, monasteries, bishops, and the papal court needed ways to collect revenues from far-flung territories and pay expenses in the places where those expenses were due. All of this happened in a world where the moral and legal boundaries around lending at interest were still actively enforced in many settings, even as practical workarounds were widely used. Banking in this period was not a neutral money business. It sat inside municipal politics, church governance, international diplomacy, and the day-to-day mechanics of trade in wool, cloth, spices, metals, and shipping. Florence was one of the places where these constraints were most creatively managed. The city's economy was deeply tied to textile manufacturing and export, and its merchant families developed techniques for partnership organization, accounting, and international correspondence that could support trade across the Mediterranean and into northern Europe. Yet Florence also carried the memory of spectacular banking failures in the 14th century, when prominent Florentine houses collapsed under the weight of sovereign defaults and overextension. That earlier experience did not prevent 15th century banking from growing again, but it left an institutional memory. The problem was not simply how to make profits, but how to control risk when the most powerful potential clients were also the hardest to compel. The Medici Bank is usually dated from 1397, when Giovanni di Bicci de' Medici established the bank's headquarters in Florence after separating his enterprise from earlier arrangements connected to a Roman operation. Giovanni was not the first Medici to handle money. The family had been involved in commerce and finance before him, and he had learned within existing Florentine banking networks. What distinguishes the Medici Bank as an institution is not an abrupt invention of modern banking, but a combination of scale, organization, and sustained political positioning. Giovanni built a bank that could operate across multiple cities at once, could handle the complex needs of the papal court, and could translate its financial influence into leverage inside Florentine governance without openly turning the bank into a state agency. From the start, the Medici model was a hybrid, a family-led enterprise that depended on non-family professionals, and a commercial institution that could not avoid becoming entangled with the power structures of its biggest clients. The basic activities of the bank can be described in a few categories, but each category contained technical details that mattered. The bank took deposits, but deposit taking in this period did not look like the later promise of interest-bearing accounts guaranteed by a central authority. Deposits could be made for safekeeping, for payments, or as working balances tied to other services. The bank made loans, but it had to manage the moral and legal environment in which usury was condemned. The bank exchanged currencies, and currency exchange was not a minor convenience. It was the core mechanism through which many profits were made and many credit relationships were structured. The bank handled transfers between cities, which required reliable correspondence, trusted agents, and a reputation strong enough that a written instruction could substitute for metal. The bank financed trade, which often meant advancing funds for shipments, insuring against timing gaps or discounting claims that would be paid later. And the bank took on public and quasi-public roles, especially in Rome, where it might collect revenues, make disbursements, and manage accounts for institutions whose creditworthiness was political as much as financial. A central instrument in these operations was the bill of exchange. In its simplest function, a bill of exchange allowed a merchant in one city to pay money to a banker and receive a written order that a corresponding banker in another city would pay an equivalent sum, usually in local currency, to a designated payee. This served multiple purposes at once. It reduced the need to transport coin. It enabled cross-currency settlements by embedding the exchange rate into the bill. It allowed credit to be extended across time, because bills often had a term and were payable at a future date, and it provided an institutional path around explicit interest, because the gain could be presented as an exchange margin between currencies and places, rather than as a declared interest charge on a loan. To see why this mattered, consider what a straightforward interest loan might have looked like in moral theology and many legal settings. Lending a sum and demanding more back simply because time had passed could be condemned as usury, particularly if the lender bore no meaningful risk. But exchange between cities and currencies was widely accepted as a legitimate service, because the costs and risks of moving value were real. Markets differed, coin quality varied, and the timing of payments mattered. The bill of exchange could therefore blend services, transfer, exchange, credit, into one instrument. It did not erase ethical debate, and it did not make every transaction safe, but it provided bankers with a socially tolerable framework in which to earn returns. This framework depended on trust and enforcement. A bill of exchange linked at least two locations and usually more than two actors: the drawer, the payer, the payee, the drawee, and the banking houses that stood behind them. If one link failed, the value chain broke. For a bank with branches, the bill of exchange was also a way to move funds internally. One branch could accept payment, another could pay out, and the difference could be settled through accounts between branches. But that internal settlement required effective record-keeping and periodic balancing. A multinational bank in the 15th century did not have instant communication. It had couriers, letters, duplicated books, and managerial judgment exercised with delays. A branch might go months making decisions before the head office could fully see the consequences. That delay is one of the recurring themes in the Medici story, because it shaped what control could mean. The Medici Bank's network expanded through branches in key commercial and political centers. Rome was central because of the papal court and the financial flows tied to it. Venice mattered because of its role in Mediterranean commerce and its own complex financial culture. Pisa became significant after Florentine control over its port, because maritime access affected Florence's trade options. Milan was a major inland power with its own political cycles and commercial connections. Geneva and later Lyon related to fair-based trade and the reorientation of certain commercial routes. Avignon remained important as a center of southern French trade and as a place associated with earlier papal administration. Bruges was a crucial node in the Low Countries, tied to the cloth trade and northern European markets. London offered access to English wool and cloth, but also exposed bankers to English politics and to a parliament that could restrict foreign merchants. Each city brought opportunities and risks, and the Medici did not operate there in a uniform way. One of the most distinctive features of the Medici Bank was that its decentralization was not only geographic but legal. Instead of operating as a single monolithic partnership, where all profits and losses automatically flowed to a single collective balance sheet, the Medici often organized branches as separate partnerships linked to the Florentine head bank. The Medici partners in Florence typically held a majority stake, while local managers and junior partners held minority stakes and, crucially, were often responsible for a disproportionate share of liability. This structure was a way to align incentives. A manager who bore significant personal risk would, in principle, manage cautiously. It was also a way to expand without committing the entire firm to the full risk of every local decision. But this structure also created limits. It made coordination more complicated. A branch manager who had room to maneuver could pursue local deals that looked profitable in the short term or that advanced personal status. The head office could set partnership terms and issue instructions, but enforcement depended on audits, on the willingness of local partners to comply, and on the accuracy of the books. If the head office was preoccupied, if it trusted the wrong people, or if it accepted reports that masked real exposures, the legal decentralization could turn from a protective device into a blindfold. Accounting is another place where the Medici story can be understood as a system rather than a set of personalities. Florentine merchants in this period used increasingly sophisticated bookkeeping. Double-entry bookkeeping was not invented by the Medici, and it was not universally standardized across Europe in the way later practices would be. But the use of ledgers, journals, and cross-referenced accounts allowed larger firms to track multiple lines of business. A bank with branches needed to know not only what each branch owned and owed locally, but what each branch owed to the others. Internal accounts, what a later period might call nostro and vostro relationships, had to be balanced. The bank also operated alongside non-banking activities tied to the Medici commercial sphere, including involvement in manufacturing and trade enterprises. Even when those were legally separate, the practical reality was that capital and influence circulated in the same family network. The most profitable and strategically important relationship for the Medici Bank was its connection to the papacy. Serving the papal court did not mean simply lending money to a pope. It meant handling a stream of revenues drawn from many regions. Payments associated with ecclesiastical appointments, tithes, dues, and other flows that the church collected through its administrative system. Those funds had to be converted, transported, and made available where the papal administration needed them. The bank could act as an intermediary, advancing funds in one place while expecting reimbursement from revenues collected elsewhere. In doing so, it gained commissions, exchange profits, and enormous reputational capital. Being seen as a principal handler of papal finances signaled reliability to merchants and princes alike. Yet papal business brought its own limits. The papacy was not a normal client. Its politics could shift with elections, factions, and external pressure. A bank aligned too closely with one papal circle could lose position when a new pope favored a different network. The papacy also had moral authority to condemn certain practices, even if it relied on bankers to keep its own machinery functioning. And the papacy's conflicts, Wars, diplomacy, internal reform pressures could disrupt payments and create sudden demands for funds. The Rome branch's profitability could therefore hide a structural vulnerability, dependence on a client whose continuity and priorities were not guaranteed. The bank's rise was also inseparable from Florence's political environment. Florence was a republic with complex institutions, formal offices, and a civic culture that emphasized the appearance of collective rule. Yet real influence often depended on patronage networks, factional alliances, and the ability to mobilize credit and favors. The Medici built political influence partly by being able to provide financial assistance, directly or indirectly, to allies and to institutions. The bank could help arrange payments, could extend credit, and could ease the practical burdens of running public life. Over time, this generated a feedback loop. Political influence helped protect commercial interests and win prestigious clients. Prestigious clients improved the bank's earnings and reputation. That reputation could be converted into more political influence. This feedback loop had limits because it could not be openly acknowledged as rule by bankers without provoking resistance. Florence had traditions and factions that opposed concentrated power. Rival families and political coalitions could exploit resentment against perceived oligarchy. The Medici therefore had to balance visibility and invisibility, to be powerful enough to matter, but not so overt as to trigger unified opposition. That balance affected how the bank was governed internally, because the leading Medici figures often had to devote energy to politics rather than to careful management of distant branches. The more their public role expanded, the more day-to-day supervision of the bank depended on trusted lieutenants. Giovanni di Bixi's generation established the model, but the bank's expansion and the family's political ascent are strongly associated with Cosimo de' Medici. Cosimo inherited a functioning banking apparatus and expanded its reach. Under Cosimo, the bank developed a European network that could interact with the most important trade corridors of the time. This is also when the bank's interaction with art patronage and civic building becomes more visible in later memory. But the bank itself remained primarily a commercial institution whose success depended on routine operations, matching deposits and payments, managing exchange, financing shipments, and maintaining branch discipline. Branch discipline is an abstract phrase, but in 15th century practice, it meant a set of concrete mechanisms. A branch had a manager, sometimes with junior partners or factors, who executed transactions and corresponded with Florence. Instructions traveled by letter. The head bank set general policy, limits on exposure, preferred clients, types of business to emphasize, and how profits would be distributed. Partnerships were renewed or revised periodically, and terms could include explicit restrictions on lending, speculation, or non-core ventures. The head bank could dispatch auditors or trusted agents to inspect books. But every one of these mechanisms depended on time and trust. Letters could be delayed or intercepted. Books could be manipulated if local partners were dishonest, or if accounting conventions were used to obscure reality. Audits were disruptive, expensive, and politically delicate, especially when a branch manager had cultivated relationships with local elites. In the best cases, the branch system worked because the incentives were aligned. Managers who held stakes in the partnership profited from prudent growth, while the Medici majority could enforce discipline by threatening dismissal or dissolution. In practice, the system produced recurring tensions. Managers wanted autonomy to pursue opportunities. The head bank wanted predictability and protection against catastrophic loss. Opportunities in international finance often came from precisely those clients and deals that were least predictable. Princes at war, courts running deficits, city-states in crisis, and merchants dependent on volatile commodity markets. This is where the limits of medieval finance become visible not as a single constraint but as several interacting ceilings. The first ceiling was enforcement. In a world without centralized banking regulation and without uniform international contract enforcement, a banker's ability to recover a bad debt depended heavily on the debtor's willingness to pay and on the banker's political leverage. If a merchant defaulted, there might be legal avenues, guild pressure, reputation damage, and asset seizure. If a duke or king defaulted, those tools were weaker. A sovereign might simply refuse payment, delay indefinitely, or retaliate against the lender. The lender might have no court strong enough to compel repayment. This was not a theoretical issue. Earlier Florentine banks had learned it through expensive experience. The second ceiling was information. Credit depends on knowing the borrower's situation, but 15th-century information traveled slowly and could be strategically distorted. A branch manager might lend based on a court's reputation, on personal assurances, or on the apparent strength of a regime, only to find that war or succession politics changed everything. A bank could diversify across cities, but diversification still depended on correlated risks. Wars could spread, trade routes could be disrupted, and currency values could shift across regions simultaneously. The third ceiling was moral and legal framing. Even when exchange devices allowed bankers to earn returns, there remained debates and enforcement pressures around usury and related practices. Banks had to maintain a plausible moral profile, especially when operating close to ecclesiastical authority. That did not prevent profit-making, but it influenced what kinds of contracts were written and how they were justified. It also influenced public perception. A bank that was seen as predatory could face civic backlash, political attack, or ecclesiastical condemnation. The fourth ceiling was capital structure and liquidity. A bank could appear wealthy when many clients had deposits and when bills of exchange circulated smoothly. But liquidity crises could arise if many depositors demanded payment at once, or if a branch faced a sudden shortfall due to a default. Without a central lender of last resort, the bank's resilience depended on its own reserves, on the willingness of allies to extend emergency credit, and on the ability to liquidate assets quickly. Yet many assets were illiquid. Claims on distant debtors, investments tied to trade ventures, or balances trapped in another city's accounts. The Medici Bank navigated these ceilings for decades, but the same mechanisms that supported growth also created pathways for decline. A bank that becomes a hub for elite clients is drawn toward deals that are prestigious, politically useful, or necessary to keep access. That is the dynamic behind many forced loans or quasi-bribes. A branch might feel compelled to extend credit to secure licenses, contracts, or protections. Over time, what begins as a strategic accommodation can accumulate into an exposure large enough to threaten solvency. The London branch is a clear example of how business opportunity and political constraint could merge into a dangerous position. England offered access to the wool and cloth economy, but foreign bankers faced domestic hostility and legislative constraints. A Florentine bank operating in London could depend on permissions and licenses, and those permissions were shaped by political bargaining. In such an environment, extending credit to powerful figures could be a way to keep the business viable. Yet the same powerful figures, kings and their circles, were among the riskiest debtors. If the branch lent heavily to the crown and repayment faltered, the branch could not easily enforce collection without jeopardizing its very right to operate. The exposure was therefore both financial and political. The specific pattern that emerges in the Medici experience is not that they invented risky sovereign lending. It is that the bank, like many financial houses, was repeatedly tempted into lending to secular rulers despite the known risk, because those relationships were tied to the bank's ability to function within regulated markets. In England, where Parliament and merchant interests could influence the conditions under which foreign firms operated, the branch's choices were constrained. When repayment failed or was delayed, the losses could become large enough to force liquidation. The bank structure could then shift liabilities. An unprofitable branch might be reduced from a full partnership to a form that limited exposure for the main house, but that did not remove the underlying losses already incurred. It merely redistributed and managed them over time, often painfully. Northern Europe posed a related problem in the Low Countries, where Bruges was a major center of trade. Operating there connected the bank to the cloth trade and to the commercial life of a region under powerful ducal authority. A branch manager could cultivate relationships with the Burgundian court, and those relationships might promise profitable concessions, toll farming rights, or privileged access. But they also created a channel through which the bank could be pulled into lending for court expenses and war. A ducal court could demand sums beyond what ordinary commercial lending would justify, and refusal could threaten the bank's standing and operations. In this setting, personal ambition could fuse with institutional vulnerability. A manager who sought status at court might overextend the branch in loans that were politically rational in the short term, but financially dangerous in the long term. These northern exposures matter because they reveal how the Medici's decentralized partnership model could fail. If the head office in Florence relied on reports that understated risk, or if it hesitated to intervene because the branch was embedded in delicate political relationships, losses could grow quietly until they were too large to absorb. At that point, the bank's response options narrowed. Audit and liquidation could salvage what was recoverable, but the greatest losses, loans to powerful rulers, were often the least recoverable. Another limit came from the evolution of trade geography and institutional competition. A banking network must constantly adapt to where trade is happening, which fairs matter, and which cities are becoming new hubs. The shift from Geneva's fairs toward Lyon's fairs in the 15th century illustrates how such changes could force organizational restructuring. Moving a branch is not simply renting a new building. It means shifting correspondent relationships, establishing new legal standing, recruiting trustworthy staff, and managing the transfer of outstanding claims and obligations. Every transition creates opportunities for error and for opportunism. If a branch relocates or is reconstituted, the new partnership terms must be negotiated, and the distribution of profits and liabilities must reflect both old balances and new expectations. Those negotiations can become a site of tension between the main house and local operators. Inside Italy, the bank faced another set of constraints: the politics of city-states and the risks of lending to condottieri and ruling houses. Italian politics in the 15th century were characterized by alliances, wars, shifting regimes, and the pervasive role of hired military leadership. Financing a ruler or a military entrepreneur could yield influence and potential profit, but it carried severe credit risk. Unlike a merchant borrower whose assets and reputation could be seized or destroyed through commercial sanctions, a military-backed ruler might simply refuse repayment. Even if he wished to repay, defeat could render him incapable. The bank might then be left holding a claim whose value depended on the outcome of wars. In effect, the bank could become a hidden participant in political and military contests without any ability to control their outcomes. At the same time, Not all bank business was spectacularly risky. Much of it was mundane and profitable, facilitating merchant payments, converting currencies, providing working capital for shipments, and managing deposit and transfer services. The bank's profitability depended heavily on volume and on reputation. A firm that was trusted could act as a clearinghouse where many transactions flowed, and it could earn small margins repeatedly. That kind of profitability is easy to underestimate because it does not produce dramatic stories. But it is central to explaining how a bank could grow large without relying solely on a few massive loans. Reputation, however, is fragile when it depends on both financial solidity and political favor. In the 15th century, a bank's name could be strengthened by association with the papacy, with major courts, and with reliable merchant networks. But it could also be weakened by scandal, by visible losses, or by political shifts in Florence itself. The Medici were not merely bankers. They became de facto political leaders in Florence. That meant that the bank's standing could rise with the family's political success. But it also meant that the bank's operations were increasingly exposed to political retaliation when circumstances turned. This becomes crucial in the later 15th century. The Medici political position in Florence did not remain unchallenged. Factional opposition, external threats, and internal crises could destabilize the environment in which the bank operated. If the family's political authority was weakened, the bank could lose protections and privileged relationships. If the family was expelled or its power broken, the bank could be attacked physically, administratively, and through the sudden withdrawal of trust. Because the bank's business depended on confidence, any perception that it was politically vulnerable could trigger a withdrawal of deposits, a refusal to honor bills, or a collapse of correspondent relationships. A bank in this era could fail not only because its assets were insufficient, but because its networks of trust disintegrated. The bank's internal governance also shifted over generations, and this shift illustrates another limit: the difficulty of sustaining professional discipline when a family enterprise becomes a political dynasty. Giovanni di Bixi's bank had emerged from a commercial environment in which careful attention to profit and risk was central. As the Medici became major political actors and cultural patrons, the family's leadership sometimes had competing priorities. That did not automatically ruin the bank, but it increased reliance on non-family managers to handle technical details. Reliance on managers is not a problem if managers are competent and aligned. It becomes a problem when oversight weakens and when managers can exploit the bank's prestige for personal advancement. This is not a story of simple corruption in a modern moral sense. It is a structural problem. In a decentralized organization, the distance between principals and agents creates opportunities for misaligned behavior. A branch manager who can present optimistic accounts, who can delay the revelation of losses, or who can justify risky loans as necessary political costs, can accumulate exposures that the main house would not approve if it had full information. The main house might tolerate ambiguity because the branch is strategically located, or because confronting the issue would disrupt valuable relationships. Over time, ambiguity becomes concealment, and concealment becomes crisis. The technical mechanisms that allowed concealment in this era were often accounting-related and contractual. A debt could be carried on books at face value, even if its recoverability was doubtful. A loan might be rolled over, treated as an investment, or shifted into a partnership account in ways that blurred categories. A branch could claim that deposits were invested, and therefore not immediately payable, reducing apparent liabilities at the cost of increased conflict and reputational damage. A manager could engage in side ventures, shipping, toll farming, speculative purchases, that were difficult for the head office to evaluate from afar, especially when those ventures were entangled with local politics. The problem was not that 15th-century bankers lacked accounting. It was that accounting could not eliminate the need for judgment, and judgment could be exploited. As the century progressed, the Medici Bank faced compounding pressures. Some branches encountered internal mismanagement. Some faced shifts in trade patterns. Some were dragged into sovereign or quasi-sovereign lending that became unrecoverable. The bank could absorb some losses because it was large and because other branches, particularly those tied to papal business, could be highly profitable. But the bank's resilience depended on the continued strength of those profitable centers and on the continued cohesion of the overall network. The Rome branch's importance illustrates a paradox. When a bank has a dominant profit center, it can mask problems elsewhere. Losses in one branch can be covered by gains in another, allowing the overall institution to continue and preserving confidence. That stability can be beneficial. It can also delay corrective action because the urgency of reform feels lower. A bank can therefore continue with poor practices in distant branches longer than it should, relying on the core's profitability. If the core then weakens, through political change, loss of papal favor, or disruption, the bank suddenly faces the accumulated consequences of earlier tolerances. It is also important to recognize that the Medici Bank's decline was not the collapse of banking in Florence. Banking continued, and other firms adapted. What ended was a particular combination: a family-led multinational bank tied intimately to Florentine political leadership and to particular networks in Rome and Northern Europe. When that combination came under stress, it could not easily be reconstituted in the same form. The years often associated with the bank's end are tied to the broader political rupture in Florence in 1494. That year is remembered as a turning point in Florentine politics, with the Medici's expulsion and the resulting upheavals. In such an environment, a bank identified with the Medici could face immediate practical threats: physical destruction of premises and records, seizure of assets, refusal by debtors to pay, and the collapse of political protections that had underwritten the bank's ability to operate, even if some branches could continue under new arrangements or as independent entities. The networked Medici Bank as a unified system could not easily survive the loss of its central base and of the family's authority. Yet to describe the bank as simply ending in 1494 risks missing what the concept of limits really means. The bank's vulnerabilities were not created in 1494. They were inherent in the environment and in the institution's own design. The end point was dramatic, but the limiting factors were long-term. Enforcement weakness against sovereigns, information delays, moral constraints shaping financial instruments, liquidity risk without a lender of last resort, and agency problems within decentralized partnerships. The Medici Bank was unusually successful in pushing against these limits for much of the 15th century. Its history shows how far a private institution could go in building an international financial network before those ceilings pressed back. To see the system at its most operational, it helps to reconstruct how a typical cycle might have worked when the bank was functioning smoothly. A merchant in Florence might need to pay for cloth purchased in Bruges or to receive proceeds from sales in London. He could go to the Medici in Florence, deposit florins, and receive a bill of exchange drawn on the relevant branch or on a correspondent. That bill would specify the amount payable, the currency, the place, and the term. The merchant or his agent would send the bill north, where it would be presented to the branch for acceptance and later for payment. The branch would pay out in local currency, perhaps after a set number of days. Meanwhile, the branches and head office would record the transaction in their books, creating an internal balance. The branch that paid out would have a claim on the branch that received the initial funds, and these claims would be settled through further transactions, shipments of metal when necessary, or netting through the ongoing flow of bills. At the same time, the branch might be receiving deposits from local clients, merchants, nobles, or institutions who wanted a safe place to hold funds and a means to transfer them. Those deposits could be used to fund payments and loans, but always with the awareness that depositors might demand funds. The branch could also finance shipments, advancing money against expected proceeds, perhaps tied to a cargo of cloth, wool, or other goods. The branch might buy and sell bills, earning margins through exchange rate differences and timing. The head office might instruct the branch to keep exposure to a certain court below a limit, while still maintaining enough relationship to secure privileges. The branch manager would interpret these instructions in a local context, deciding whether a particular loan was within policy or whether it was necessary to protect the branch's position. When the system worked, it generated a kind of distributed stability. Each node had local knowledge, the head office had overall strategy, and the bank's reputation allowed paper instructions to function as money. When the system failed, the failure often came from the same distributed nature. Local knowledge could be used to justify risky choices. The head office's strategy could become outdated as politics shifted, and reputation could collapse rapidly once confidence was shaken. Bills of exchange themselves could become instruments of both profit and risk. Because bills were linked to exchange rates and time, bankers could engage in sequences of exchange, sometimes called dry exchange in later description, where transactions functioned effectively as loans with disguised interest. Such practices could generate profit, but they also required careful management of exchange rate risk and counterparty risk. A bank that misjudged currency movements or that relied on a counterparty who failed to honor a bill could suffer losses. In addition, if authorities decided to crack down on certain forms of exchange as usurious, the bank could face legal and reputational consequences. Even without crackdown, the moral debate could influence the bank's choice of clients and the way it documented transactions. Another operational dimension was correspondence and information flow. Letters carried instructions, reports, market intelligence, and warnings. A competent bank depended on a steady stream of accurate letters, but the volume of correspondence itself could become a burden. A head office flooded with reports might miss critical signals. A branch manager might delay bad news to buy time or to protect his position. The reliability of couriers mattered. So did secrecy, because financial information was valuable and could be exploited by rivals or by political enemies. These are not peripheral issues. They were part of the bank's infrastructure, as real to the 15th century institution as vaults and coin. The Medici Bank also intersected with the textile economy in ways that matter for understanding both profits and vulnerabilities. Florence's wealth was tied to cloth production, and banking and textiles were intertwined through credit and trade finance. Banks could finance wool purchases, pay for dye and labor, and advance money against finished cloth. They could also participate directly through affiliated workshops or partnerships. These connections diversified revenue, but also linked the bank to commodity cycles and to disruptions in supply. If war or embargo disrupted the flow of wool or the ability to sell cloth abroad, merchants could default, and banks could be left with claims tied to failing ventures. In such a setting, A bank's exposure was not only to borrowers, but to the underlying stability of trade routes and political conditions. Trade routes in the 15th century were shaped by a patchwork of tolls, privileges, and political boundaries. A bank operating across them had to navigate not only markets but institutions. City councils, princely courts, guild regulations, customs officers, and ecclesiastical authorities. A branch might gain an advantage by securing a toll concession or by being favored at court, but such advantages could be reversed by political shifts. This created a constant pressure to maintain relationships through gifts, favors, and sometimes credit. The line between commercial necessity and political entanglement was often thin. In this environment, the Medici Bank's success depended on more than cleverness. It depended on the ability to integrate finance with governance. In Rome, integration meant fitting into the administrative needs of the papal court. In Florence, it meant managing the tension between republican forms and oligarchic reality. In Bruges, it meant dealing with ducal authority and the networks of northern trade. In London, it meant navigating English merchant politics and royal finance. Each location required adaptation, and adaptation carried risk. The decline of the bank, then, can be traced as an accumulation of stresses across these themes. In some cases, branch managers made imprudent loans to rulers whose repayment was doubtful. In others, branches were drawn into speculative ventures that exceeded their mandate. In others, shifts in trade patterns reduced the profitability of a location, making it harder to cover fixed costs and to justify the risks of operating there. In the background, the Medici family's political role in Florence absorbed attention and created enemies. By the time the major political rupture arrived, the bank was not a perfectly healthy institution struck down by a single event. It was a complex organization whose vulnerabilities had been developing within the limits of medieval finance. Yet it would also be misleading to treat the Medici Bank story as simply a cautionary tale of hubris. The bank functioned for nearly a century, and during its height, it coordinated transactions across much of Western Europe. That scale was not achieved by accident. It required a system of partnerships, letters, accounting, and reputation that could hold together despite slow communication and fragmented authority. The bank's achievements show the capacity of private institutions to create trans-regional financial infrastructure before the rise of modern states with centralized fiscal systems and central banks. Those achievements also illuminate what had not yet been built. The 15th century did not have a robust framework for sovereign debt enforcement. It did not have a unified legal system that could compel repayment across borders. It did not have a lender of last resort to stabilize liquidity crises. It did not have standardized public accounting or transparency requirements that could prevent managers from hiding losses. The Medici Bank developed partial substitutes for some of these missing elements: reputation as enforcement, partnership liability as incentive alignment, audits as oversight. But each substitute was incomplete and costly. The story therefore ends where it began, with constraints that shaped possibilities. Medieval and Renaissance finance could be sophisticated, international, and innovative, but it operated inside a political and moral environment that could not be bypassed. The Medici Bank grew by mastering the tools available: bills of exchange, branch networks, careful accounting, and elite relationships. It declined as those same tools met their limits. Information delays, misaligned incentives, sovereign and courtly credit risks, and political shifts that could dissolve trust faster than any ledger could record. In the aftermath, what remained was not the disappearance of financial technique, but its redistribution. Other banking houses continued to work, cities continued to manage debts, and rulers continued to seek credit. The Medici themselves continued as a political dynasty in later forms, with a legacy far broader than banking alone. But the particular institution known as the Medici Bank, as a networked multinational partnership centered on Florence and held together by a family's reputation and political position, illustrates a boundary line in European financial history. How far private credit and merchant organization could carry international finance before the absence of stronger enforcement and stabilization mechanisms, and the dangers of political entanglement asserted themselves begin with Rome, because Rome shows the bank at its most systemically important and at its most structurally exposed. The Roman branch was not simply a place where Florentine merchants happened to have an office. It sat close to the apostolic chamber and the curial administration that collected and spent across a wide geography. Under Pope John XXIII in the early 15th century, the Medici's Roman operation rose into a formal position within papal finance as a depositary for the apostolic chamber. In practice, that meant the bank could become the place where papal funds were deposited, recorded, and made available for disbursement, while payments due to the papacy in distant regions could be routed through the bank's channels rather than physically carried to Rome. This role transformed scale. The headline figures that survive for the Roman branch in the 1420s show how far the flow of institutional deposits could exceed the private capital of the firm. Around 1427, the Roman branch is recorded as holding roughly 100,000 florins on deposit from the papal curia, while the total capitalization of the Medici Bank as a whole was far smaller, on the order of tens of thousands of gold florins. The immediate implication is not that the Medici had 100,000 florins as free wealth, but that their Roman books were acting as a reservoir for other people's money that could be drawn down as needs arose. This was what made the bank useful and profitable, because holding such balances allowed the branch to execute transfers and exchange at volume, to earn fees and margins repeatedly, and to place funds for short intervals where they could earn returns. It also meant the branch's solvency and liquidity were tightly linked to confidence. If a major depositor demanded rapid disbursement while the branch's assets were locked in claims and transfers not yet settled, a crisis could emerge quickly. The Roman branch's most valuable product was speed, and speed in this period meant a reduction in the months it could take to move value across Europe by physical means. The papacy drew payments from places where the nearest reliable banking center might be far away, and where formal enforcement could be difficult. Some papal agents still relied on ad hoc carriers, but a bank with international correspondence could make money available in Rome within weeks when it arrived in a northern center, and a letter of advice confirmed the credit. That letter of advice was not a ceremonial document. It was an instruction that functioned as a trigger for book entries and for a planned sequence of bills of exchange. The distance between Bruges or London and Rome could be traversed financially by paper, and by reputation faster than metal could travel under guard. But the Roman branch also illustrates how the bank's most prestigious client was also its most complex. The papacy's income streams were not regular like a merchant's sales receipts. They were tied to ecclesiastical administration and to politics, and they could spike or collapse based on decisions at court and events beyond it. When the papacy spent, it spent on things that often made repayment uncertain in the ordinary commercial sense. Diplomacy, subsidies, military costs, building, patronage, and the day-to-day expenses of an enormous household and administrative apparatus. In this environment, the branch could be drawn into advancing funds against expected revenues not yet collected, or against revenues whose collection depended on local compliance. The more the bank's officers integrated with papal financial routines, the easier it could become to turn a service relationship into a credit relationship, where the bank's own balance sheet absorbed delays and uncertainties in papal cash flow. This is where the mechanics of bills of exchange meet the politics of appointment. If the Roman branch was collecting in one region and paying in another, it had to manage exchange risk and timing risk. It also had to manage the danger that a change in papal leadership or in the curial faction in control would shift business to a rival house. A bank could lose its position quickly if it was no longer trusted by the chamber, or if a competing network promised better terms, or if politics demanded a redistribution of financial patronage. In such a system, the bank's relationship management was not a modern marketing concept. It was an institutional struggle to remain the chosen conduit for the largest flows. That struggle could tempt a branch to accept unfavorable terms, to extend more credit than prudence recommended, or to tolerate arrears longer than a purely commercial calculation would allow. The Roman branch also shows another element that often sits quietly in the background. The bank was not dealing only in coin and paper. It could trade in high-value goods closely tied to elite consumption and to courtly life, including precious metal objects. Such dealing could be profitable because demand in the curia for silver plate and luxury objects was real, and the branch sat at the center of that demand. But the presence of goods on the asset side of a bank's books is never neutral. Goods fluctuate in value, can be hard to liquidate quickly, and can represent a form of disguised credit if they are sold on terms or taken in settlement for debts. When a bank accumulates such assets, it may be improving earnings in ordinary times while making its balance sheet more complicated in stress. Now shift to Bruges, because Bruges shows the bank's exposure to a very different kind of power. A commercial metropolis within a political landscape dominated by ducal authority and war finance. The Bruges branch was created to sit inside the northern trade corridor that connected Italian merchants to the cloth economy of the Low Countries and to the wider exchange system of the North Sea. In its functioning years, Bruges was where bills were bought and sold, where balances were cleared, and where Italian houses competed to serve merchants and courts. It was also where the bank's branch model, with its incentives and its blind spots, became a concrete vulnerability. The best way to see this is to look at what the branch manager could do, and why the branch's local logic could diverge from the main house's logic. A manager in Bruges could win enormous status by cultivating the Burgundian court, because proximity to the court could yield privileges, contract opportunities, and protections. But cultivating the court often meant money. It could mean direct loans, advances, and financial favors that were not priced like ordinary commercial credit. It could also mean taking on projects that flattered the manager's position but did not strengthen the branch, acquiring rights connected to tolls, attempting ventures in shipping, or participating in side deals that made the manager visible. These choices were not always irrational in the moment. A manager could believe that the court's favor would stabilize the branch's operating environment, or that a toll farming concession would generate steady returns, or that owning ships would secure transport capacity for merchant clients. The problem is that each such move added a layer of risk that was harder for Florence to monitor and harder to unwind. In the Medici case, Bruges is inseparable from the long tenure of Tommaso Portinari. The surviving record, including internal memoranda attributed to Lorenzo de' Medici, treats Portinari as a manager whose decisions steadily undermined the branch. One strand was his pattern of lending to the Burgundian Duke Charles the Bold far beyond the risk limits that had been set. Another strand was his involvement in ventures that ended badly, including purchases connected to galleys, where losses could come through partial resale at a loss, shipwreck, or piracy. These are not incidental details. They demonstrate the difference between banking that is essentially book-based and banking that becomes tied to physical maritime risk. A bank that owns ships or holds major interests in them is no longer merely intermediating. It is exposed directly to the hazards of sea transport and to the military and criminal environment that can turn a cargo into a loss. Portinari's courtly lending illustrates the basic limit of enforcement again, but now in a more specific configuration. Charles the Bold was not a merchant who could be pressured by a guild. He was a ruler with military power and political priorities. If he borrowed and did not repay on time, the bank's remedies were limited, especially if the branch depended on the duke's goodwill for its daily functioning. The branch could be caught in a trap where repayment was doubtful, but refusal to extend more credit was dangerous. Over time, what begins as a manageable exposure can become a dominating portion of the branch's assets, concentrated in one political debtor whose fate is tied to war and succession. The record also shows that partnership terms could be a battlefield. Branch partnerships often contained explicit restrictions on how much could be lent to particular clients. In the Bruges case, the partnership articles are described as having forbidden Portinari to lend more than a set ceiling, while memoranda record the Duke's bad debts in sums far beyond what those restrictions contemplated. This is what agency failure looks like in a 15th-century firm, not a vague misalignment of incentives, but a breach of written limits that the head office had insufficient power to prevent in real time. The end stage of the Bruges branch illustrates how accounting and contract language could be weaponized. When a depositor demanded funds, a manager could resist by reclassifying the deposit as something else, claiming that it had been invested into the partnership rather than held as a repayable liability. That maneuver might protect liquidity in the short term, but it destroys confidence and invites litigation and political retaliation. It also shows how porous the line between deposit and investment could be when a bank promised secrecy to its clients and maintained different sets of internal records to track the reality of balances and profits. The secrecy that protected clients and the bank's competitive position also created conditions where disputes could not be resolved cleanly by public verification. When the Medici leadership finally intervened, intervention took the form that was available, dispatching trusted agents, auditing books, and dissolving partnerships through the contractual mechanisms that had been built into the system. Dissolution was not a clean reset. It was a salvage operation. The assets on the books were not all truly collectible at face value. Claims on a ruler in trouble were not equivalent to coin. Goods held as assets might not sell at recorded values. The liquidation of the Bruges branch, like liquidations elsewhere in the network, therefore reveals another medieval limit. Balance sheets could be written with an appearance of solidity that depended on optimistic valuation, and liquidation forced a harsher accounting. From Bruges moved to London, because London shows how a branch could be simultaneously valuable, constrained, and ultimately sacrificed. The London branch connected the bank to England's economy, especially the wool and cloth trades that linked English producers, urban merchants, and export networks. For an Italian banking house, England offered opportunities to finance trade and to profit from exchange, but it also came with strong political risk. English rulers and parliaments could impose restrictions on foreign merchants and bankers, and war and factional conflict could disrupt the normal enforcement of debts. The Medici London branch is known to have ended in a drawn-out liquidation completed in 1478, with recorded losses exceeding 50,000 gold florins. That scale matters because it demonstrates that a single branch failure could absorb a large portion of a bank's accumulated profits and could threaten the wider network's stability. It also matters because the pattern of loss is consistent with the worst kind of borrower in this era: a sovereign debtor whose repayment was not guaranteed and whose incentives could change with political conditions. In the London case, the record associates the branch's failure with large unpaid debts linked to King Edward IV. Whether those debts were contracted as straightforward loans, as advances tied to fiscal needs, or through the more complex devices of exchange and trade finance, the structural point is the same. The branch was exposed to a political center that could delay repayment without immediate consequence, and the branch was operating in a jurisdiction where coercing the crown was not an available option. The London failure also shows how losses could migrate within the network. Once London was liquidated or reduced, its problematic claims and obligations could be shifted to another branch for management, particularly to Bruges, which sat closer to the northern clearing system, and where managers were already embedded in the political commercial environment of the Low Countries. This kind of internal transfer was not necessarily improper. It could be a rational attempt to concentrate expertise and to net balances where settlement was easiest, but it could also be used strategically, shifting liabilities away from one partnership and into another, depending on how profits and losses were shared among partners. In a system where different partnerships had different equity shares and different distributions of profit rights, moving a line of business could alter who bore the pain when the business soured. That is another limit of the partnership model. It could reduce risk at the group level in some circumstances, but it also created incentives for internal maneuvering when branches faced crisis. Now consider Geneva and Lyon, because they show a different kind of vulnerability, not primarily courtly default, but the need to follow the geography of markets and fairs. Geneva became important as a node tied to fair-based commerce, a place where merchants could settle accounts, exchange currencies, and trade financial instruments in a periodic rhythm. A bank branch embedded in such a system had to understand not only local trade, but the calendar of fairs, the movement of merchants, and the evolving preference of international networks. When the balance of fair-based trade shifted and Lyon rose in importance, a bank that wanted to remain central had to move with the flow. The transfer from Geneva to Lyon is recorded as occurring in the 1460s, with the Lyon branch formally established on March 25, 1466, in at least one surviving account of the bank's organizational history. The date itself is less important than what it represents: a deliberate institutional reorientation toward where clearing and settlement were increasingly happening. Establishing a new branch meant creating a new partnership, defining equity shares, and ensuring that the staff could handle the specialized work of exchange in a high-volume environment. A fair city was not merely a place to accept deposits. It was a place where exchange rates were constantly negotiated, where bills were discounted and sold, where the timing of usance and the credibility of drawers and drawees could be the difference between profit and loss. A fair-based branch also sharpened the information problem. To make money from exchange, a branch needed accurate, timely knowledge of rates in multiple cities and of the likely direction of movement over the term of a bill. That is why 15th-century banks generated so much correspondence between branches. A decision to sell many bills on a particular route could be profitable if rates moved in the right direction by the time the bills matured, but it could also be damaging if rates moved against the bank. Without modern hedging instruments, the bank's risk management consisted of diversification, careful attention to the timing of bills, and continuous adjustment of positions through the flow of new transactions. A branch in Lyon, sitting amid an expanding fare system, could be highly profitable if managed well, but it also existed in a competitive environment where rivals were watching the same rates and seeking the same advantages. Now return to Italy and look at Venice and Milan, because they demonstrate how domestic branches were not necessarily safe, and how intercity Italian politics created their own ceilings. Venice was a major commercial power with deep maritime networks. A Medici presence there could connect Florence to shipping, trade goods, and a market where exchange was a constant business. Yet Venice also had its own institutions and could be suspicious of foreign influence. A branch operating in Venice had to operate within Venetian legal and political constraints, and it also had to navigate the risk profile of Venetian merchants, who could be exposed to maritime loss, wartime disruption, and market shifts in the eastern Mediterranean. The Venetian branch could generate strong profits in the bank's earlier decades, and some accounts of the bank's performance attribute a substantial share of early profits to the Italian core, with Rome and Venice together dominating returns in the period before the major northern branches were fully established. That distribution is important because it suggests the bank's early stability depended on a relatively tight geographic sphere, where the Medici could supervise more closely, and where information traveled more quickly. As the bank expanded north, the profit base diversified, but the supervision problem intensified. Milan, founded later as a branch, illustrates a different relationship with power. Milan in the mid-15th century was a major territorial state in northern Italy, and banking there could mean engagement with ducal finance, court needs, and the commercial life of a regional capital. A Milan branch offered access to a concentration of wealth and to administrative demand for financial services. It also carried the familiar temptation. The court could be a client not only for payments and exchange, but for credit, and credit to a court is always linked to politics. If Milan's regime changed priorities, if military campaigns demanded sudden funds, or if fiscal administration faltered, repayment could be delayed. Unlike in a purely merchant environment, the branch's future might depend on the goodwill of a ruler who could punish refusal. Across these cities, the bank's operating model repeated. Partnership terms, a manager with local autonomy, capital supplied partly by the Medici and partly by local partners, and a steady exchange of letters and accounts with Florence. The limits repeated too: slow information, incomplete enforcement, and the inability to separate finance from the political ecosystems that controlled access and security. Put these branches together, and the bank begins to look less like a single institution and more like a federation bound by a family name, by majority stakes, and by continuous correspondence. The federation model is what allowed rapid growth. It is also what made the bank vulnerable to cascading failure. When one branch took a heavy loss, it did not automatically destroy the rest, but it created demands. To cover deposits, to maintain confidence, to rescue the branch or to liquidate it, to manage lawsuits and political fallout, and to redistribute bad assets to where they could be managed. Each rescue or liquidation consumed attention and capital. In a bank whose leading family members were also the leading political actors in Florence, the attention budget was limited. A crisis in Florence could occur at the same time as a crisis in Bruges or London, and the management system could be stretched beyond what letters and audits could handle. This is the point where the bank's internal accounting architecture becomes decisive. The bank maintained records that tracked branch balances and partner equities, and it also used internal, secret, books to record the reality of deposits and profits more accurately than public-facing or externally shareable accounts could. Secrecy served multiple functions. It protected clients, it protected the bank's competitive position, and it reduced political vulnerability by obscuring the scale and identity of deposits. But secrecy also made internal verification harder and increased the cost of decisive intervention, because a major audit was not merely a technical act. It was a social and political act that could signal trouble and trigger panic. When the bank's leadership, especially under later generations, became more focused on maintaining political dominance, financing patronage, and navigating factional threats, the organizational drift became a technical issue as much as a moral one. If a branch manager in Bruges could secure favorable partnership terms, reduce the practical oversight imposed by Florence, and present accounts that delayed recognition of loss, the head office could find itself in a position where the only choices were bad: expose the crisis and accept reputational damage, or tolerate the ambiguity and hope that political conditions would improve. In the North, political conditions could worsen suddenly, as wars disrupted trade and as rulers' solvency depended on battle outcomes. In England, dynastic conflict and factional politics could make repayment a bargaining chip rather than a contractual obligation. In Burgundy, military ambition could swallow funds at a scale no commercial margin could match. Even the bank's strengths could accelerate the decline. A prestigious house could attract deposits and business in part because it seemed too connected to fail. That inflow increased volume and profit in ordinary times. It also increased the scale of liabilities that would have to be honored in stress. A house trusted by the papal court could attract other institutional clients, magnifying the consequences if papal business shifted away. A house that dominated exchange routes could be exposed to correlated exchange and political shocks, affecting multiple routes at once. By the late 15th century, the visible sequence of collapses and liquidations in the northern branches was not an isolated series of accidents. It was the manifestation of a single structural problem. A bank that had extended itself across jurisdictions without the stabilizing institutions that later banking systems would rely on, and that had done so while being tied to a ruling family whose political fortunes could rise and fall sharply. When one branch failed, it weakened confidence. When confidence weakened, depositors and correspondents became less forgiving. When forgiveness vanished, book assets that had been carried at optimistic values were suddenly revealed as fragile. The events of 1494, when the Medici were expelled from Florence amid foreign invasion and internal upheaval, mattered because they attacked the bank's center of gravity. A networked bank could sometimes survive the failure of a branch. It struggled to survive the destruction or seizure of its home base and the collapse of the political protections that had made its name credible. Once the Florentine center was destabilized, rivals could move in, clients could switch allegiances, and branches could act independently, protecting their own position by severing ties to a now dangerous brand. A branch in Rome might decide it was safer to proceed on its own, rather than remain tied to a compromised Florentine family. A branch in Lyon might be taken over or replaced by a rival firm embedded in the local commercial ecosystem. The network could dissolve not because every asset was worthless, but because the legal and reputational glue was gone. If the Medici Bank's history is reconstructed from these branch mechanisms rather than from later legend, its meaning becomes more precise. It demonstrates that 15th-century banking could build a continent-spanning payments and exchange system through partnership engineering, correspondence, and ledger discipline. It also demonstrates that without strong cross-border enforcement, without stabilization against liquidity shocks, and without an institutional separation between political rule and private balance sheets. Such a network could be undone by the very relationships that made it powerful. The Medici were not unique in encountering these limits. They are unique because their bank is unusually well documented, and because their political and cultural legacy kept the banking story in the foreground to wrap the system up cleanly. It helps to keep the bank story anchored in a small number of recurring mechanics, and then follow what happens when those mechanics meet stress across multiple cities at once. At its most effective, the Medici Bank functioned as a distributed payments and exchange machine. A Florentine headquarters coordinated majority stakes and policy, while branch partnerships in cities like Rome, Bruges, London, Venice, Milan, and later Lyon conducted the day-to-day business, taking deposits, executing transfers, buying and selling bills of exchange, and extending short-term credit that was often inseparable from currency exchange. The key point is that the bank's internationality was not an abstract reach. It was a practical capacity to substitute paper, book entries, and trusted correspondence for the movement of coin, and to do so repeatedly enough that small margins became large profits at scale. Rome shows the bank at maximum scale and maximum dependence. Once the Medici became depositary to the Apostolic Chamber around 1420, the Rome branch handled curial funds as deposits and disbursements in volumes that could dwarf the bank's own paid-in capital. A commonly cited snapshot from 1,427 places roughly 100,000 florins on deposit from the papal curia in the Rome branch, compared to an estimated total bank capitalization around 25,000 florins, which illustrates how much the institution relied on confidence and liquidity management rather than on sheer owned capital. When that confidence held, the bank could turn institutional balances into an engine for transfers and exchange that attracted more business. When confidence wavered, or when papal politics shifted, the same dependence could become an existential weakness. Bruges and London show how political credit could quietly overwhelm commercial banking. In London, the branch accumulated large bad exposures associated with the royal court, and the surviving summaries of the bank's collapse repeatedly connect the branch's failure to unpaid royal debts and to a liquidation completed by 1478, with losses on the order of 50,000 florins. The decisive structural fact is not simply the king didn't pay, but that a foreign banking house had no reliable enforcement mechanism against a sovereign debtor and could not safely threaten the political authorities on whom its license to operate depended. That combination, weak enforcement plus dependence on permission, turns a loan into a hostage relationship. In Bruges, that same logic appears at even larger scale because the branch manager, Tommaso Portinari, became deeply entangled with the Burgundian court. Internal Medici memoranda later attributed to Lorenzo de' Medici faulted Portinari for excessive lending to Charles the Bold beyond partnership limits, and record bad debts to Charles alone in the range of £16,150 gross, against articles that reportedly forbade lending more than £6,000 gross. Whether each figure is taken as a precise accounting number or as the rough order of magnitude conveyed by internal complaint, the mechanism is clear. Branch autonomy plus courtly pressure plus delayed oversight allowed concentration risk to grow until liquidation became a salvage operation rather than a correction. The shift from Geneva to Lyon illustrates a different kind of limit, the need to follow the geography of clearing. The Medici reorganized their presence to keep pace with where fairs and settlement were concentrating, and the Lyon branch is described in surviving governance studies as established on March 25, 1400, 466 after the transfer from Geneva. This kind of move could keep a bank central to exchange flows, but it also underscores how contingent profitability was on infrastructure that the bank did not control. Fair calendars, merchant migration, and political stability in the regions that hosted settlement. All of this sits inside the bank's internal architecture. Separate branch partnerships with majority Medici stakes, minority local partners, and written limits that were enforceable only through letters, periodic audits, and the threat of dissolution. That structure made rapid expansion possible and could, in theory, contain losses. In practice, it also created agency risk. A manager could rationalize dangerous loans as necessary for local survival, obscure deterioration in the accounts, or reclassify obligations in ways that postponed the day of reckoning. The same secrecy and flexibility that protected clients and preserved competitive advantage also raised the cost of transparency and made decisive intervention politically and reputationally risky. When you put these pieces together, the limits of medieval finance stop being a single dramatic failure and become a set of ceilings that press down at the same time. Cross-border enforcement was weak, especially against rulers. Information moved slowly, and distant branches could drift far before the center could see clearly. Liquidity depended on confidence without a lender of last resort. Moral and legal constraints shaped what contracts could look like, which encouraged instruments like bills of exchange that blended services and credit into forms that could be profitable, but also easier to misuse. And because banking was intertwined with permissions, courts, and civic politics, a bank's balance sheet was never fully separable from the political weather of the places where it operated. The Medici Bank was unusually effective at pushing against these limits for much of the 15th century, precisely because it combined technical tools, partnership organization, correspondence, ledger discipline, and exchange craft, with privileged relationships, especially in Rome. But those same relationships, and the decentralized structure that made the network scalable, also provided the pathways by which losses could concentrate and spread. By the time political rupture arrived in Florence in 1494, the network's cohesion had already been strained by branch-level failures and the long afterlife of bad debts. In that sense, the bank's end is best understood not as a single collapse caused by one event, but as a multinational trust and settlement system encountering the outer boundary of what private credit, paper instruments, and family reputation could sustain in a fragmented and intensely political Europe.